So Ola Electric Mobility's quarterly report came out a few days ago for Q4 FY2025. I am going to go through that. This video is recording of my own research and analysis of company's past and present financial performance and future capabilities. I am open to any feedback or critique on this. However, under no circumstances should be should this be construed as financial advice or recommendation of any form. So Ola Electric Mobility Limited right now is trading at 50 rupees per share. It has a total market cap of 21,000 crore. So if you look at its performance for last 5 days, it's about 5% down. Even today, it's 6% down so far. Month wise, it's just 2% up. So roughly at the same level, it went down and then came back up and then went down again. However, if you look at the 6 months data, it is 48% down. It's not 48%. Yeah, it's 48, 49% down. Year to date, again, it's 42% down. For last 1 year, it's 44% down. And overall, if you check, it's 44% down from its IPO price, which came out last year. However, if you look from the top was 133. So it's pretty much about 60% down from the top. But that is just about the share price. So the quarterly report came out few days ago. Let's check this. I'm on the NSE portal. If you look at the total income, which is basically the total revenue, why do they have two different data for total income and then net loss or net profit or loss? This could be quarterly and this could be yearly, but yearly should be the sum of these four numbers, right? So it shouldn't be more than 18,000 lakhs. So let's check this in detail. Promoter has a holding of 36%, public has 58% holding, or 57, yeah, 58% round figure. Shares held by employed trust is 5.8%. So why does this have so many updates? This is investor call update, newspaper publication, outcome of board meeting for financial analysis. Let's check this. Yeah, we should go through this. Let me zoom this. So this is from Ola Electric Mobility Limited to NSE and BSE, outcome of board meeting held on 29th May and submission of audited financial results, standalone and consolidated. Is to inform you that the board of directors of Ola Electric Mobility held a meeting, has considered and approved audited financial results for quarter and financial year end March 31. So should we look at the consolidated statement directly or the standalone first? We should always check consolidated. If you have to check one of the reports, always check consolidated because it will include the performance of any subsidiaries which the company holds. Standalone does not provide the overall picture of any company. In our opinion, and to the best of our information and according to explanation given to us, aforementioned consolidated annual financial results include annual financial results of the entity mentioned in Annexure 1 are presented in accordance with regulations, give a true and fair view of conformity with the recognition and measurement principles laid down. Okay, basis of opinion, emphasis of matter, management's and board of directors' responsibility for consolidated financial results. In preparing the consolidated annual financial result, the respective management and the board of directors of the companies included in the group are responsible for assessing the ability of each company to continue as going concern, disclosing as applicable matters related to going concern and using the going concern basis of accounting unless the respective board of directors either intends to liquidate the company or to cease operations. Liquidate means selling the company in different parts, or cease operations means just to stop the business altogether or has no realistic alternative to do. So going concern means company which is continuing its operations as usual. Auditor's responsibility, I'm going to skip this. Other matters, the consolidated annual financial results include the unaudited financial results of 7 subsidiaries located outside India. Why does this company has so many subsidiaries? It's not an old conglomerate, it's a new company, it's a startup whose financial information reflects total assets before consolidation adjustments of rupees 334 crores, total revenue before consolidation adjustments of rupees nil. So there are 7 subsidiaries whose financial information has total assets. So those subsidiaries has no revenue, but the total assets of those companies are 334 crores and total net loss after tax of rupees 91 crore and net cash flows of 6 crores for the year. So why, if it has no revenue, then why does it have loss after tax and cash flow? So things like this raises suspicion over the company. Suspicion, 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 suspicion meaning feeling or thought that something is possible, likely, or true, causes distrust. Our activities were regarded with suspicion. Pronunciation, suspicion, 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 suspicion. Our opinion on the consolidated annual financial results, insofar as it relates to the amounts and disclosures included in respect to these subsidiaries, is based solely on financial information. In our opinion, and according to the information and explanations given to us by board of directors, these financial information are not material to the group. What basically they are saying is it doesn't matter. These are very small compared to the overall figure, so it's not material to the group. Okay, let's check the financials and then we will come back to this to see if we should be we should be suspecting any fall or any fault here, or if we can ignore this. So this is an extra one. How many subsidiaries they have? 11. Or is there more? No, just 11. So this is all their list of entities included in the consolidated annual financial results. Ola Electric Mobility Limited. This is the listed company, parent company. Then they have Ola Electric Technologies Private Limited in India only, wholly owned subsidiary. Why do they want to build a subsidiary for everything? Ola Electric Charging, Ola Cell Technologies. So if I have a feeling that for all the different departments, they have created a subsidiary. For cell technologies, they have a different subsidiaries. For charging, they have a different subsidiary. For technology part, could be IT or something. They have a different subsidiary. Ola Electric Mobility USA, Ola Electric Mobility Netherlands. Then they have Vitergo in Netherlands, which is wholly owned subsidiary of this company. So they have a subsidiary in Netherlands, and then the subsidiary has another subsidiary as well. Vitergo again. So there is a subsidiary, then there's second level of subsidiary, then there's third level of subsidiaries. Then all of these are Netherlands. Ola Electric, UK partner, UK Private Limited, EIA Trading Shanghai. When a company has so many subsidiaries, it raises a lot of questions. The company itself is not big enough to warrant having so many different 11 different branches of the company or 10 different subsidiaries of the parent company. So if the operations itself is not big, can a single company not handle all of these, or is or are so many subsidiaries created for any financial misadventures? So next we have consolidated financial results for quarter and year ended March 31st, 2025. Alright, so these data are in crore. Well, it's not a lot, to be honest. For a listed company, 611 crores, 100 crore is a billion. So if the market cap of the company is 21,000 crore, then this total revenue from operations is only 600 crores, which is anyway drastically down from 1,000 crore or 1,600 crores, 1,000 crore from last quarter and 1,600 crores from year on year. For a listed company, you'd think that at the very minimum, if the company is listed for 21,000 crores, round figure, let's say 20,000 crores, at the very minimum, the company would be making 2,000 crores on a yearly basis, right? So for 600 crores, okay, so if we take this last year's revenue, it is 5,000 crores. So if the company is listed for 20,000 crore, it is 4 times the revenue. This year, the revenue has actually come down. So it is little over 5 times. 5 would be 18, so 5.5 times revenue. All right. The better thing as investors would be if the revenue amount matches the market cap of the company. That is one metric which gives a lot of clarity to me as an investor, that how much is the revenue compared to the market cap of the company. In the best of scenarios, revenue would be much higher than the market cap. However, that's just one parameter of the so many hundreds of parameters, hundreds of tens of or hundreds of different parameters. So revenue from operations, other income, the total revenue was 728 crore, which is substantially down. And I also remember the news that they had not registered all of their vehicles in Feb or March. I remember this news coming through. So they had informed that they sold so and so number of vehicles to NSE and BSE, to the stock exchanges. But I don't know in which portal where you can see all the registered vehicles. That data came out that all of the vehicles which they sold were not actually registered with the authorities. That means either they are lying to the stock exchange or they were lying to the registration thing. I'm not sure what that is called. So anyway, round figure, if we check, the revenue is around 5,000 crore, and the revenue has actually gone down rather than going up year on year, and that explains why the stock price has been falling so considerably. If you check from year to date, at the start of the year it was 86, now it has come down to 50, so there's been 40% fall. Even if you check for 1 year, uh, the IPO came out in August 2024, then very quickly it went up to 146. So it's nearly 30. So it's nearly 66% down. It's only 33-35% of that top figure left. Now let's come to expenses. Cost of material consumed. It is very high. Cost of material consumed will be its COGS, cost of goods sold, right? So if you remove this for last year, the reason I am looking at 2024 data as well is because the revenue has gone down in the current year. So it's better to do 2 years analysis than to stick to just 1 year or just one quarter figure. So if you look at this data, this is 90% of, or rather, this is 4 and 5, 9 times 4, 9 times 5. So this is 80% of the revenue amount. Roughly, this would be the same figure as well. 80% would actually be just 4,000 crore. So this is 4,400. So actually their gross revenue or their gross margin has slightly gone up to 20% from what it was earlier. They have been able to uh, control their cost of materials consumed. If you compare to this, yeah, so the change has mostly been in this quarter because it was really high, more than 86% of this figure for last quarter, and or rather for the quarter before that, but for the last quarter it came down to roughly around 50-60%. I don't know if they have correctly projected everything or not. Why was there a substantial drop in cost of material consumed? Purchase of stock in trade is insignificant. Change in inventories of finished goods, stock in trade, and work in progress. Once again, it's not a lot. However, if you check this with this, if you add these two, it will go up to about 5,000 crore. Then it will be a high amount compared to the overall revenue. Yeah, so one of the ways of doing that is we can add these two up. That is change in inventories plus cost of material consumed. So overall, it will be 500 of the 700 here. If you add these two, this will be 800 of the 1100 here. It's the same amount. There's not much here. Employee benefit expense. It's once again for the full year. For last year it was 439 crores, so roughly 110 crore each quarter. This number has slightly gone up. Now it has come back to 100 crores for last 2 quarters. Therefore, for the 2 quarters in the middle, it would have gone up, and then they have been able to control that. And then there are other expenses as well. So if you look at the total expenses, it's way higher than the revenue. So see, this is the problem when your cost of goods sold is so high compared to the revenue you are generating. If you add this to change in inventories of finished goods, stock in trade, and work in progress, this becomes 500 crore of the total income of 700 crore. And we still have to look at the other income. Where is this coming from? So it could be 500 of this 600. Even if you ignore this quarter and take the previous quarter, it was 800 of the 1000 crores. So only 20% of that is left for other expenses. Then only you are left with only 200 crores, and your other expenses, employee benefit expense itself is 100 crore, and then you have other expenses of 550 crores. So unless we get a breakup of this, if they are spending in research and development in R&D activities, which will increase their revenue in future, that's a different thing. That is an investment. But if it is real expense in running the company, if it is operational expense, then they are left with no choice but to increase the price of their two wheelers. If they increase the price, their sales will go down. Anywhere their reviews are not good. You get so many negative. So for the total financial years for this year, total revenue was under 5,000 crore and total expenses were over 6,000 crore. So they have a loss, which is before finance cost, depreciation, amortization, and tax expense. So this is basically the opposite of EBIT, earnings before interest, EBITDA. Yeah, earnings before interest, taxes, and depreciation and amortization. So this is in negative. So they had a loss of, at enterprise level, they had a loss of about 1,300 crores. Last year it was just 1,000 crores. So their overall loss has gone up. Now the finance cost has also gone up. There are too many red flags here. Everything is negative about this company. So the only hope you have is growth, that the revenues will continue to grow, and in future it will be able to control its cost and turn profitable. So if the company can do that, then it may turn out to be a good purchase, but otherwise it's not looking good for this company. So their interest cost has doubled for this financial year compared to the last financial year. For this quarter itself, it has doubled from last year. So they are spending 122 crores in finance cost, which is basically interest for the loans they have taken, which is higher than their employee benefit expense. And then they have a high amount for depreciation and amortization expense as well. Loss before exceptional items and tax, so it goes up if to 2200 crore, more than 2200 crores. So their loss is more than 10% of the total market cap of the company. Their loss is more than 10% of the total market cap of the company, and the loss has only gone up. Now, some people say that depreciation and amortization expense are not real expense, but if you believe in what Warren Buffett and Charlie Munger says, it is a real expense. In fact, this expense you have to spend the money even before you start selling the product, even before you have revenue coming in. So you if you have to replenish the uh, your property, plant, and equipment, if you have to replenish the property, plant, and equipment, if you have capital expenditure which is required to just maintain this top line, then it is very real cost. You are spending money upfront, so it has a negative cash flow. We will check that when we reach the cash flow statement, if they have provided one. And then there's an exceptional item, refer note number 12. Let's go down and check that. Okay, so we'll check that later, but it is insignificant. It is very small compared to this figure. Then there's tax expense. They don't have any taxes because they are a loss making company, and they have an overall loss for the company. So if you add these two figure, it's very close to 4,000 crore. Now the question for me is, why should I buy a company selling for 21,000 crore which has made a net loss of 4,000 crore over the last 2 years? Will it turn profitable in coming years? If, let's say, if I have big enough, I'm an investor of large means and I have the ability to buy this company outright for 21,000 crore. So the how do I make money? Do I make money from running operations, or do I make money by liquidating the company? And by liquidating the company, I mean, is its net current assets larger than what it is selling for? I don't think so. We will check that when we reach the balance sheet. Other comprehensive income, again, these are not big enough. So per share, it has lost 5 rupees compared to 4 rupees. So see, right now it is selling for 50 rupees. So it lost 10% of that. So my laptop just lost power and I lost the recording of balance sheet and cash flow statements. So I will have to redo that again. So it is going to be light. I won't be able to explain as much as I did. When I went through it initially, I don't feel good having lost that recording. The power of my laptop just went out. Battery has been acting up for a couple of days. I really hate this HP laptop batteries. Like in 6 months, the battery starts going dead. Why do I have to spend money every 6 months to replace a new battery? If you look at from the other side, it's good for the company. Keep replacing the battery and keep buying HP products. This is what these companies do these days. They can't innovate, they can't sell new products, so they reduce the reliability of the products. Once you have a HP laptop, you are stuck with that. Keep buying the batteries. Same with the printers. You buy a printer um, for a cheap price, but then you keep buying expensive ink and papers. So anyway, I've already gone through the income statement. I will go through the balance sheet now. So their total, remember, their market cap is 21,000 crore, or round figure we can assume it to be 20,000 crore. Their total assets or total equities and liabilities is 11,000 crores. Half of it is roughly coming from the IPO they raised last year. The asset before that was 7,700 crore. Current assets is 4,400 crore. Half of that is property, plant, and equipment, which has gone up by 400 crore. or by 500 crore. Then they have capital work in progress has come down. They have right of use assets and intangible assets. Then further intangible assets under development. If you add these three, it will be about 1500 crores. So these things doesn't have a lot of tangible values. In good times when the company is flourishing and doing well, if you sell the company, if the company is acquired by another bigger company or merge with another company, these assets will fetch good value when the company is growing year on year. But if the company is going down, then these intangible assets has no meaning, has no value. No one pays any money for this. So these are not tangible assets and should largely be ignored. The benefit of these assets are already reflective on the net revenue of the company. Then they have some investments and other financial assets and non-current assets. So the total asset of the company is 4,400 crore, which is up from 3,700 crore for previous financial year. Then in current assets, they have total assets of 6,660 crores. They have an inventory of 700, 800 crores. Then they have cash and cash equivalents. Then they have bank balances other than 3 above. So why is this not part of cash and cash equivalent? If it is current asset, that means it can be redeemed within the next 12 months. But they have 3,200 crore roughly. Then other financial assets, there is a star mark, and that is includes bank balance of 525 crore. So this includes a bank balance of 525 crore. Why is that not already part of this anyway? So of this current asset, roughly half of that is equity and half of that is liability. So in equity, because they have certain amount of equity because they have come up with IPO last year itself. So basically, this is their equity capital and their reserves and surplus. So total equity they have right now is 5,000 crore, but the company is selling for 4 times of that amount. Before the IPO, they were in net loss of 28 or roughly 2,900 crores, and they had instrument entirely in equity in nature, 2,900 crores. So they were a loss-making company. They came up with an IPO, and it was fully subscribed, and now they have money in the bank. Now, when it comes to liabilities, they have a financial liabilities or borrowing of 1,700 crores. Then they have lease liability. The problem with these lease liabilities is they will show this in the balance sheet. They have a liability here, and they will show right to use assets on the asset side, but they don't show these expenses on the income statement. They will directly uh, show this in the cash flow statement. So we have to be careful of that. Now there are some provisions, some non-current liabilities. Total non-current liability is 2,400 crore. Then they have a total borrowing here. Now if you look at the borrowing, this is the current borrowing of 1,300 crore and non-current borrowing of 1,700. So they have a total borrowing of 3,000 crore, which is up from 2,000 crores, which they had last year. So they have not only raised money from IPO, but they are also raised money through debt. So they must have issued bonds. And then they have lease liability of 200 crore as well. If you combine this is total 500 crore. Do they have non-current lease liability? Yes, right to use assets. But current lease assets, we really need the details of this to figure out what are other financial assets and current assets. So then they have account payable to MSME and then other than MSME, which is nearly 1,000 crore, which is 20% of their total revenue. Other financial liabilities. So they have a lot of liabilities. They don't have any profit. They are making loss at EBITDA level, which is not good. And then if you add depreciation and amortization cost to that, that means if we come down to EBIT level, they are making a lot of loss. Then this is the breakup given segment wise. I went through it in the original recording, but I'm not going to go through this now because there is nothing substantial here. Once I know that they are losing money through operations, I really don't have anything to analyze here. Now I will come to the cash flow statements. Once again, I won't go in much detail through line item wise, but they are losing cash through operating activities. Last year, they lost more cash than the loss they have in their income statement. There, they have a loss of nearly 2,300 crore, and they have lost more cash through operations. For the previous year, they have lost only 625 crores, or if you take this 633 crores compared to 1,500 or 1,600 crore of loss in the income statement. So their cash loss has gone up as well. If you look at the operating loss before working changes, that has gone up as well. So the major amounts which they have added back to the loss for cash flow from operating activities is depreciation and amortization. Then they have this interest income here, and then they have this finance cost. So that is basically interest coming in uh, for their investments, and interest they have to pay for the money they have borrowed. Okay, if you borrow money and you have to pay interest on that, but you have that cash now. If you just deposit that cash in a term deposit in a FD, you would be earning money through that. Now, can you get higher interest than what you are paying your debt holders? If you can, then it's a profitable opportunity. If you can't, then you are losing money. You might as well, you need to put that money to use rather than making money from that, because they have raised money through equity through an IPO, but then they had raised money through debt as well. And now, if they did it before they came with the IPO, that is a different thing. But they have done that for the entire year. Now, after all the changes in the inventories, account receivables, and account payables, that is the working capital changes, they are left with loss of 2,400 crore, which is roughly half of the revenue they got for the entire year, which is a big amount. Now, if you come to net cash used in investing activities, so for a good company, for a profitable company, it should always be negative rather than positive. Positive net cash used in investing activity means the company is liquidating its assets. So it should be negative, but you have to see where they have spent that money. So they have an acquisition of property, plant, and equipment of 662 crore, which has come down from 925 crores for the previous year. But then they have this development expenditure on internally generated intangible assets, which seems to be basically R&D expense, but it's intangible assets. It could be IT assets or whatever. I don't know. IT assets should not be intangible assets. You have a software. Is that intangible or tangible? I think in modern world you can consider, if you have a software, you can consider it to have some value, even though it is not physical in nature. Then proceeds from interest bearing deposits, investments in interest bearing deposits. So basically they sell their investments, or maybe their investments mature, they get the cash from it and then make new investments. So this year they have made more investments than they got from maturity of their older investments, which was 7,400 crore, and now they have made 9,400 crore. So they have made 2,000 crore of extra deposits in investments, extra investments. It could be fixed deposit in bank or something else. I'm not sure. Once again, they have not given the details here. It was pretty similar for the previous year. But all in all, now see, they have used net cash used in investing activity. And if you add this net cash used in operating activity, this is over 5,000 crore. And this is what they raised from IPO. So this is their net cash flow from financing activity. There are other details as well. Proceeds from non-current borrowing. So they have raised some debt last year as well. This is what they paid to their investment bankers. Payment of lease liability, including interest. Now this part, this is what I believe is equivalent of rent and should be showed in the income statement. But for the accounting standard which they follow in India now, they have the option to Either they have the option, I don't know if it's an option or mandatorily they have to capitalize it and show it in their balance sheet as assets and liabilities, but the payment itself is shown in the cash flow statement. This is not shown in the income statement. I don't see this anywhere here. Depreciation, sell, loss on sale of property, plant, equipment, interest income, then again finance cost. So the significant ones are just depreciation and amortization, interest income, and finance cost. Inventories, financial asset, trade receivable, other assets payable. So I don't see this figure 153 crore as payment of lease liability anyway in adjustment in the income from operating activities. Proceeds from sale of debentures, once again this is the money they are raising as debt. So they are left with very little cash in their bank account now. It's just 62 crores, not 62,000, not 6200 crores. It's just 62 crores of cash. So they will need to borrow money, and in high interest rate environment I'm not sure how that is working out. So in the original recording I had gone through each of the line items in more details, but I don't have energy left now to go through those. All in all, I didn't like the company as much and its financial performance, and we have got a lot of negative news about Ola in last few months or year or couple of years. I'm not a fan of this company. So they have some notes here. Parent company, NSE, BSE. They have all their subsidiaries listed here. Mhm. The figures for this are balancing figures between the audited consolidated figures and published unaudited year-to-date figures for 9 months. Group has negative cash flow from operations during current year amounting to this, which is primarily on account of continued operating losses and lower than expected growth in sales volume. They have no growth. How will they have growth with all the negative news coming? And every few months you get a news of an Ola bike uh, going up in flames just by the heat produced by the battery. Their after sales service is not very good as well. There are so many negative. Imagine when your customers are going to the extent of torching your showrooms, then that means they have been really frustrated. If your current customers are frustrated, you are not going to get future customers as well. That word of mouth review would not be good for you. They have to make a lot of improvements. Accordingly, the group management has carried out an assessment which requires the group to consider mitigating circumstances in order to support its operations and meet its continuing obligations. The group's management has carried out an assessment of its going concern assumption and believes that group will be able to continue to operate as a going concern for the foreseeable future and meet all its liabilities as they fall due for payment. Okay, wow. That looks like they just say whatever needs to be said. They don't say what is actually in their mind. They say what would be the idealistic thing for the company. There's a lot of imaginary stuff which they say. I'm not a fan of the promoter especially as well. He is very good at playing people. That's the feel I get from it. When the nationalistic fervor is high in the company, he will use nationalistic feelings to sell his bike. So he actually does not believe in the performance of its bike in isolation. He has to use those nationalistic fervor to sell his bike and other products he's selling. To arrive at such judgment, the management has considered a available cash and bank balances, which is hardly anything, expected future operating cash flows of material subsidiary based on its business projections from expansion of its business operations, increasing gross margins, launch of new products, and expected operational efficiencies. Basically, what they are saying is everything is going to go right for me. I am going to launch new products. I am going to increase my business operations. Gross margins are also going to improve, and operational efficiencies are going to, everything is going to be positive for the future. Then why wasn't it positive for last 1 or 2 years or more than that? What is going to change to bring all of these positive changes? And this is too much expectation. You think your margins are also going to improve and your sales are also going to improve, and you are seeing all of that in a high interest rate environment where we are in a global downturn. Many countries are on the brink of going into recession. How can you project, even though India is growing, the growth itself is not as fast as it should be? So how can you project that your sales are going to increase and then your margins are also going to increase as well? Available credit limit, this is what they are actually banking on. This is what I feel, I believe. If the banks continue to pay credit to them, they will be able to meet their liabilities. Ability to raise borrowings from the bank. C, expected future operating cash flow from material subsidiary based on its business projections. How do you believe your, on what factors do you believe that your subsidiaries are going to be cash flow positive next year if it hasn't been for this year? They haven't provided any details for that. Further, the board of directors of the holding company, in their meeting dated this, has approved a resolution to raise funds up to 1700 crores to issuance of non-convertible debentures and other eligible debt securities. See now, they have just come up with an IPO last year. It hasn't been a year yet. They came up with an IPO in August. We are in June, July, August, so we are like 9 months out from IPO, and they say they will need to raise more money, and they will do so using non-convertible debentures. Debentures are nothing but bonds without any security. So it will likely be high interest rate bonds as well. So it will be high interest rate debt. They are not making money through operations. They are just raising capital as much as they can and then burn everything. Their burn rate is just too high. Accordingly, these consolidated financial statements have been prepared on a going concern basis. The company raised non-convertible debentures totaling 200 crore for general corporate purpose. So that is this figure which we saw here. Proceeds from issue of debenture 200 crores. 200 crores. During the year ended this, the company had completed its IPO of its equity shares with face value of 10, issue price of 76. Now it is selling at 50 per share. Issue and sell of this. The company's equity share was listed. Proceeds were 5,000 crores. Utilization of net of IPO proceeds is summarized below. Net IPO proceeds to be utilized as per prospectus. Utilization of IPO proceeds abhi tak, how much of that has been used so far? Unutilized amount. So capital expenditure to be incurred by our subsidiary Ola Cell Technologies for project specified in project prospectus. So it is 2800 crore and they haven't spent a single paisa of that till now. So they've raised money for capital expenditure and haven't spent anything so far. Repayment or prepayment in full or part of the indebted incurred by our subsidiary Ola Electric Technology Limited 800 crore. So they had some debt which they have repaid now for 800 crore. Expenditure into research and development 1600 crore. They have spent only 315 crore. They still haven't spent this 1200 or nearly 1300 crore. Expenditure to be incurred for organic growth initiatives. Of the 350, they have spent 217. So this could be for taking those leaseholds for showrooms. General corporate purpose, they have spent most of the money again. So they haven't spent a single paisa from the IPO money on the capital expenditure. They have spent very little on the research and development, but they have used the money for payment of the debt and for normal operating activities, and they are left with very little money of that part. So this money they cannot spend for general operating activities. This is for capex. They have to spend it on capex, and this is for R&D, and they have to spend it on R&D. So they will need to raise money now for day-to-day operations, and that is not good. If they raise money through debt, they will be left with interest payments as well. And how are they going to get if they are not profitable EBITDA wise? They will not have the ability to pay interest through operations. The crores are temporarily invested in fixed deposit, like I suspected. They have done an FD, and so they are getting interest out of that. Above IPO funds have been raised by the company to be used in its wholly owned subsidiaries, ultimate beneficiaries. During this quarter, the group had reported an exceptional item of 23 crore towards reversal of production link incentive accrued in previous financial year. The reversal was consequent to issuance of final standard operating procedure by Ministry of Heavy Industries, in which the period of eligible sales for incentive computation has been amended from application date of DBA to certification date. Okay, whatever. During the quarter ended this, Series C 1D and E compulsorily convertible preference shares totaling Etna shares, this is 1.5 billion shares, were converted into 436 million equity shares. This is pre-IPO. The conversion was approved by the shareholders at extraordinary general meeting. During the quarter ended this, Series A, A1 and B compulsory convertible preference shares totaling 1.4 billion shares were converted to 1.3 billion equity shares. The conversion was approved by shareholders on 19 July. So again pre-IPO. During the current year, Central Consumer Protection Authority has requested information with respect to various consumer grievances registered on National Consumer Helpline, on which company has provided its response to the CCPA. Consequently, that means after that, the company has received notice under Section 19(3) of the Consumer Protection Act seeking additional information, which was also furnished by the company. The management does not expect any material impact of this matter on the financial results of the group for the year ended. Is the management does not expect, but what if there is any financial impact or material impact on the financial results? As the Consumer Protection Authority, Central Consumer Protection Authority, closed the case, or are they still investigating? There's a lot of risk in this company. With risk comes growth as well. Not necessarily, those are two sides of the coin. Either you will get risk or you will get growth. But if the share price is already very high, it's already four times as compared to revenue, then it's very hard to get growth in future. If the market cap falls less than revenue, and then if the company turns profitable, that would be a really good chance for growth, for capital growth. See, this is the issue I was talking about earlier as well. During the current year, the company has received email communications from NSE in March 25 seeking information with respect to variance in the number of vehicles sold as per Vahan portal. So that government portal is Vahan portal, as mentioned in the company's press announcement dated 28 February 25. So what the company has announced that they had sold X number of vehicles, but there was variance Uh, when compared to the Vahan portal, there was variance when compared to the Vahan portal, where all of the registered vehicles are listed month-wise, I believe. The company wide its response dated this has provided all the requested information to the stock exchanges, which includes a clarification stating that the press announcement of 25,000 units of vehicles sold. So they have announced that they have sold 25,000 units, but they had, if I remember correctly, they had something like only 8,000 vehicles registered in the Vahan portal for the month of Feb 2025. So 25,000 units of vehicles sold was with respect to vehicle booking. So they are showing the bookings as sold, but they have not delivered the vehicles yet. So see, this raises another point of suspicion on the company. How do you believe their financial figures? Someone has booked the vehicle but has not taken the delivery. Now, I'm not sure if that is the right accounting standard. I don't believe it should be the right accounting standard. If a vehicle is booked but not yet delivered, the revenue should not be recognized. Revenue should be recognized at the point of the uh, operation. That means at the point when the sale took place. So when they hand over the vehicle and they get the money. At the time of booking, I don't believe people would pay complete amount. There would be some booking charges, maybe 10% or whatever, but they would not be paying the complete amount at the time of booking itself. So you cannot add that to your revenue. You will have a liability in that case also. I'm not sure if they have added or not added that amount to their revenue, and then have I didn't see any liability where they've what is the term for that? It's prepaid revenue. It's a liability. Prepaid they have like there is an asset called prepaid expenses. They have something similar for liability as well when they have got the money upfront. So they have cash on the asset side, and on the liability side they have prepaid bookings or something, prepaid revenue, because they are yet to deliver the vehicle, right? The company has further clarified that as per company's revenue recognition policy, you cannot have your individual revenue recognition policy. You have to follow the accounting standards. Revenue is recognized by the company on the basis of delivery of the scooter to the customers after completion of registration process. So they should not have shown that revenue. The management does not expect any material impact of these communications on the financial results of the group. So what they are saying here is they haven't done any misadventures on their financial statements, because revenue should be recognized only when they have delivered the vehicle to the customer. But they have reported to the stock exchanges that they have sold 25,000 units of vehicle. But if you haven't sold that, you have only booked it, then why say you have sold in the month of February? This is misleading the investors. And I'm not sure if it was only for the month of February or if they have done it earlier as well. During the financial year, the group had purchased the business pertaining to operating experience centers, vehicle service, vehicle refurbishing, and logistics services from Ola Fleet for total consideration of 136 crores. The fair value of identifiable net assets acquired was determined to be 134 crore, resulted in a goodwill of 2 crore. Okay. So, see, both Ola has the same promoter. The Ola Fleet Technologies, I believe, should be that Ola we know traditionally as the cab booking site. So, maybe they have, honestly, I don't know. But if Ola is buying from Ola, why do they have a goodwill? Who got this money? If I own Ola Fleet Technologies, 100%, if I own 100% of the equity in Ola Fleet Technologies, and then there is a listed company called Ola Mobility, and I have an asset under Ola Fleet for 134 crore, and I use this money from the publicly listed company to sell it for 136 crores, then I pocket the extra 2 crore of goodwill. That 2 crore went directly to somebody's pocket. That was not a listed company. So this is 22nd May. So just last month they have approved to avail an indebtedness up to an aggregate amount of 1700 crores. So they will be issuing debentures of 1700 crores in one or more tranches, not exceeding its borrowing limit as approved by shareholders. So their cost of goods sold includes cost of material consumed, purchase of stock in trade, and changes in inventories of finished goods, stock in trade, and work in progress, excluding certain other direct expenses such as employee benefits and other expenses. If I go back to their income statement, so here they are in cost of goods sold, they are adding this cost of material consumed plus purchase of stock in trade plus change in inventories of finished goods, stock in trade, and work in progress. If you add all of these up, like I did earlier, it will be about 500 crores. So 80% of this amount. All in all, this would be like somewhere in that range of 75 to 80% of this amount. All right. Now they have standalone. I don't have any energy left to go through this. Standalone is not very important, and there's hardly any figure here. So we are just going to skip this. See, when you come to the standalone, you will find this paid up equity share capital and other equity as being very high amount, but they don't have any operations. So what the standalone does is it has all of these wholly owned subsidiaries. So it has divided the company into many different subsidiaries, and they all conduct day-to-day operations on behalf of this company. In consolidated, we have the revenues and expenses added up for everything. So we should always look at the consolidated statement, not standalone. In some rare cases, looking at the standalone would be a good idea, but not for most of the companies, especially not for going concern companies. So there's hardly any meaningful figures here. So the point of investigating these companies is if you like what you see, if I like what I see, I can dig deeper and deeper and deeper. But if I don't like what I see, I don't have to continue digging deeper. I can leave it, and that's what I'm going to do with this company. I didn't like what I see so far. I don't like what I see so far. Here I have overall data of the company. This was based on previous data. Remember, today the company has fallen by over 6%. So this is based on older data. The market cap was 236 billion. Billion is 100 crore. So 100,000 crore. Basically, the company yesterday was selling at 23,000 crore. Today it has come down to 21,000 crore. Enterprise value by sales is 5.3, which has been a jump from the recent amount. If you look at the total enterprise value, it's roughly the same figure, 23,000 crore or 237 billion. And it's negative at the EBITDA level. Its net income is negative. If you take a look at the financial statements for the older data which we have, there had been decent amount of growth the company has enjoyed. till it came with its IPO. But after the IPO, the performance has gone flat, or it has actually gone down a little bit. And this is not unusual with many startups. In fact, if you read the books going back to 50 years to 100 years back, if you read the investing books from 100 years ago, you will find this figure where you will find this pattern where companies or startups grow till the time of IPO, and then they fell flat because that growth was not real growth. It was based on more and more capital being invested in the company. It wasn't the company wasn't it's The company itself wasn't profitable. Operations were not profitable, but they were using the money either in marketing or to give discount to the customers to increase its revenue every year, which this company has done for the last 3 years before the IPO. And once the IPO came, it's not as easy to raise capital anymore. They won't have private equity investing in the company anymore. Private equity would have all taken an exit pre-IPO and post-IPO. Mostly post-IPO, they would have multiplied their money 10 times and sold it to the general public. Even if you look at the gross margin, it's hardly anything. EBITDA is negative. Net income margin is negative by 50%. If you look at quarterly data, there's almost no improvement. If you compare Q4 to Q4, there is slight improvement in gross margin, but how many years are you going to wait for it to become EBITDA positive, for it to become net income positive? The company will need to raise more and more capital. Most likely it will be raising through debt, and then it will have higher amount of interest to pay every year. So I don't know when company can sustainably become profitable. So we have very high cost of revenues. So gross profit margin is about 13%, what we saw here, right? Yeah, it was about 18%. So like I said earlier, more than 80% is going in cost of goods sold, which is not good. Best companies will have very high gross profit margin, which will be to the scale of 70-80%. So if you look at the other operating expense, it has jumped many-fold in last 4-5 years, which is again not a good indicator. The SG&A expense is kind of everywhere. Why has it come down? Have they fired employees post IPO to reduce their SG&A? Will they be able to earn as much revenue with less number of staff? There are all of these unanswered questions. And while their other operating expenses has jumped 20 times, has their revenue jumped 20 times? No, it has just jumped 10 times. But it's nearly half of what they are making as revenue, which is again not a good indicator. Look at for this year, for FY23, their total revenue was 26 billion and other operating expense was 7 billion. So which is like 25% of that, but that has now jumped to 50% of the revenues, almost 50%. Even last year they had revenue of 50,000 or 50 billion, and other operating expense was just 12 billion. So it was exactly 25% here, but now that has jumped a lot. And see how their net interest expense has jumped. And I suspect they would have to pay more and more interest every year now. And hence this loss, I don't see them paying dividends anytime soon. Their total current asset is 66 billion compared to their total liability of 59 billion. Total current liability is 35 billion. So they have cash in the bank, so they should be able to pay current liabilities for now. But if you continue to be loss making for another year, you will run out of money. You have to find a way of doing business sustainably, in a sustainable, profitable way. And I don't think this is a sustainable, profitable business. So I'm going to end this video here. Just let me take a last look at this. Negative cash from operations, negative cash from investing, and they have invested in market and equity securities. Isn't that the investment in subsidiaries? So they raise money from common stock by selling common stock, and they put it in subsidiaries, and they took an operational loss. Whatever. So that's all for this video. Thanks for watching.